Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, Head of UK Rate Strategy, and I'm joined today by our global market specialists, Giles Gale and Cummins. Okay, Kevin, I'm going to kick off with you because despite the fact that it was a short holiday week for you in the US, and certainly at the beginning of the week, I think all of us in Europe and the UK were waiting for a bit of action for the US to return. It's obviously a very busy data week. We're recording this on Thursday, so we've just had the upside surprise on the ADP data. We're obviously waiting for the employment data tomorrow, which will be out by the time most listen to this. What specifically in that data will you be looking for? And I suppose what will the FOMC be watching for in terms of what will make them feel justified in having to hike more?
Yeah, sure. Well, as you said, the calendar in the U.S., despite the only 3.5 days of trading this week, is quite action packed. I think culminating at the end of the week, tomorrow being Friday, will be the payroll report for June, and the expectations are for another really strong gain. Consensus heading into the ADP data were for payrolls to increase by about 225,000 or so. We were a little bit above that at 240,000, and I think while the Fed is clearly focused on missing their inflation objective, I think this month the key data are on the employment side. We have seen some modest improvement on the inflation data since the middle of last year that Chair Powell has flagged. And we got a kind of a step in the direction a week or so ago when we got a little bit softer than expected core PCE price data, particularly that services ex housing number that Powell really hung his hat on to determine future inflation. And they want to see inflation moving back down to 2%. So those data were a step in the right direction. And they'll have another key inflation metric than the CPI on July 12th that'll matter ahead of the July 26th FOMC meeting. But I think what will be really critical for this one, because they've only gotten kind of hints and some improvement in inflation since the last meeting in June when they paused, will be the labor data. Because of the relationship between inflation and jobs, they probably aren't going to be too comfortable if the labor data remain really strong, and that they're probably going to continue to miss on their inflation objective if the labor market is still as tight as the data imply. So I think tomorrow's employment report will really go a long way in managing expectations ahead of that July 26th FOMC meeting. So I think that those headline numbers will be really important. They're obviously always important for the Fed, but I think this month they take on some added importance because 1 or 2 months of inflation data probably aren't enough to move the needle all that much. And it seems like if you listen to various Fed officials led by the chair, Powell, he's been moving in the hawkish direction. Back in last week when he spoke in Europe, he really honed in on the fact that they're missing on their inflation objective and really put the weight of evidence there that there's a baseline assumption at the Fed that a strong consensus and a strong number of officials expect to go at least 2 more times this year, and there's only 4 meetings by the end of this year. So the debate on inflation is going to persist in future months. But if we were to see a really surprisingly weak employment report, I think that would manage the market's expectations, which is very much priced in for a hike in July, a resumption of another 25 basis point hike, to pull back those to some extent. But, as you said, we had the ADP data this morning, and if anything, they far surpassed expectations, coming in almost at 500,000 on the month, showing a re-acceleration in payroll growth. So if the BLS employment report is anything like that, I think it's going to really solidify expectations that the Fed's going to hike again later this month, which is obviously different than what we thought coming into the week.
And how much has that view also been influenced then by the FOMC minutes that we had this week? Obviously, the minutes are always a little bit, I guess, backward looking in that, you know, we've sort of had 3 weeks of data and central bank narrative, et cetera, since then. But did we learn anything new from those minutes that have kind of influenced your thinking about the policy path ahead as well?
Yeah, they are kind of looking in the rearview mirror a bit, as you said. So I be honest with you, I was hoping we'd get more information there. Some of the it does show a diverse set of opinions and some different opinions on the outlook for the economy in the U.S. But they are representative of the entire committee. So, you know, there's 18 Fed officials at the board or on the FOMC. So it's not surprising that, you know, to try and put together a consensus view takes some work. And it seems like the large majority of voters and even non-voting members have expected that they're going to resume hikes this year. There's a little bit of a difference of opinion that, you know, someone like Chicago Fed President Goolsbee or perhaps Atlanta Fed President Bostic are on the more dovish side. So, you know, their views were expressed in the minutes that, you know, people are very unclear about the outlook. So the pause that was put in place in June may be the best course of action going forward. But I think the majority of members are on the lookout for more hikes ahead, depending upon the data. And it's obviously very data dependent. We're at a level here in the US where we're very close to the terminal rate if we're not already there. But I think the Fed's telling us that at least for now, their base case is, you know, a couple more hikes this year. But, you know, if the data turn, those expectations will have to reset. And, you know, some of the more dovish members of the committee may ultimately be right. But we'll see, you know, over the course of the next 2.5 weeks or so, we'll get some more data that will manage expectations ahead of that July meeting. And by the time the next meeting comes around in mid-September, we suspect, if our forecast is right, that we're going to tip into a recession later this year, that payroll gains are going to slow pretty dramatically relative to at least tomorrow's expectation of, you know, anything north of 200,000 or so is probably maybe the end of it before we start to see softer data ahead.
Okay, lots to watch out for then over the next couple of weeks.
Indeed.
Right, Imogen, is this the moment to go to the UK then? And where, to be honest with you, markets have been pretty volatile again, haven't they?
That's a nice way of putting it, I think.
And now I guess that the first thing to talk about is the fact that today we reached your target that you reset from, I think the last time you reset it upwards from 4.3 to 4.6% for 10-year gilts, and we hit that. So what are you thinking about the risks from here?
Yeah, so I mean, the short answer is that I think the risks are still skewed to the upside when it comes to gilt yields. You know, the 4.6% is kind of an output from our fair value model, which we call, or I call, a fundamental factor fair value model. So that kind of has as inputs our view on bank rate, inflation, growth, supply, and, you know, how we think global central bank policy rates will evolve as well. And so our view on all of those factors hasn't changed since we reset the target to 4.6%. So the output, you know, the fair value that model gives as an output is still 4.6%. But I think there's enough reasons to think that we're in a kind of overshooting environment where we'll see gilt yields get higher than that still. Most of them center around the supply outlook. I think risks are skewed pretty heavily still to the upside on supply. We're heading into an election year where, although there's not a huge amount of fiscal headroom, any that we do have will be recycled. I think QT continues because the bank clearly has to do more tightening than they previously thought. And against that backdrop, they might as well do tightening via a channel that they're not being very heavily criticized for very publicly. The higher that bank rate and yields go, the larger the cost of that QT is, which ultimately those costs get absorbed into the public finance equation and just add to higher gilt supply. And of course, the higher that bank rate goes, the larger the costs to the government of funding its debt is. So the supply risks are skewed pretty one way. At the same time, we still have this real lack of demand from the natural buyers of gilts. We're seeing some demand materialize from other sectors like the private, non-bank domestic sector, but that's really all concentrated at the very front end of the curve. And we're just in an environment, I think, where, whilst there's no real confidence around the trajectory of inflation or how high bank rate is going to go, there's really no backstop to this bearish momentum. I don't see anyone kind of stepping in to significantly backstop yield. So although fair value might be at 4.6%, I could easily see an overshoot. Well, we're already overshooting that value today, but, I wouldn't really look to fade this move until gilt yields got higher than where we are now. And I think we're talking more in the region of kind of 4.9% before I think that they've gone much too far beyond fair value.
Okay, but I suppose it hasn't just been in duration. I mean, there was a front-end led component, and we are, the market has been moving to price in more and more and more action from the Bank of England. I think that the terminal rate is now well above 6%. And so I think that needs a little bit of discussion as well. Maybe you can just run us through.
Yeah, I mean, of course, there's been kind of two elements to this underperformance of gilts over the last, quarter, really. It's been half about the supply story that I've just run through, but also half about this kind of bank rate view and a reassessment of bank rate expectations. That's moved a lot this week on really not a lot of news. There's been basically no data in the UK to speak of, no central bank speak, apart from what may well be a career highlight of Andrew Bailey appearing on the CBBC this morning, the children's version of BBC, which I didn't expect to be watching when I woke up this morning, but there we go. So, it's really moving on not a lot. And now, like you say, has got to quite stretched levels. We're closing in on 6.5% as peak rate, which is well beyond what we think the peak will be at 6%. But the problem is that I see no kind of real near-term catalyst for that reversing. We get labour market data next week, which is obviously pretty key. But, our forecast is for average weekly earnings to remain high, uncomfortably high for the Bank of England's forecast. And even if we see a marginal drop, or even if we see a drop, way outside of market expectations, I think it's going to take more than 1 month of data for the market to feel comfortable that, bank rate doesn't need to go significantly higher than here, and that the bank has done enough. So yes, I think that market expectations have gone too far, but I don't see a very near-term catalyst for a reversal of that. And even in a scenario where we do see a repricing, in a more dovish direction back to our kind of base case of 6%, which is still significantly higher than spot bank rate, I don't think that's enough to kind of offset all those other bearish influences that I was talking about at the longer end of the curve.
All right, fine. And I guess a little bit more on the niche side, even more niche than the CBBS that I think everybody's going to be very interested to know that you immediately switch on your reflex to enjoy your breakfast with. No, listen, on swap spreads, front end swap spreads in particular have been moving. There's a little bit of there's a number of elements to that story, and you've just published a note on that. So I think we'd like to hear the potted version of that.
To be clear, I wasn't watching CBeebies. I watched it only after I knew that Andrew Rayleigh was up. So yeah, swap spreads. Yeah, like you say, a little bit more niche. So perhaps I'll just keep it very high level for the pod. But what we've really seen is gilts outperforming. So gilt yields moving lower relative to swap rates in the UK. And that's been driven by two things over the last week. The first is just that there's been some demand for front-end gilts. I was talking earlier about this household or private kind of non-bank domestic demand that we're seeing. A lot of that is concentrated at the very front end. We saw a strong BOE QT auction earlier this week, and then a strong auction from the DMO of the 2025s that kind of illustrated the strength of that demand. But we've also had a bit of speculation this week around how the DMO may or may not change the rate charged on its standing repo facility, essentially. And that is a bit too niche, I think, to go into the details of the pod. So if anyone is interested, then please do reach out. But I think the conclusion here for the market is that in the very near term, some of these pressures and swap spreads that we've seen can continue. I think that demand that we've seen at the front end continues, not least because there's cash flows in July that should support that. We get redemptions of a maturing bond. We also get coupons, which are due to some short dated bonds as well. But also because I think it's probably likely that the DMO do shift this the rate on the standing repo facility such that its spread to bank rate grows. But there's a limit to really how much richer gilts can get on asset swap, largely because that charge that I was talking about with the standing repo facility only really matters to the extent that there's collateral scarcity in the market. And whilst there seems to be enough demand for front-end bonds at the moment that it may well matter, actually, given the fact that there's plenty of supply to come, that there's upside risks to that supply, that the risks to any additional supply that we get are probably skewed to it being at the front end rather than the back end of the curve, because that's where the demand is, and the fact that BOE QT is expected to continue. Collateral scarcity is much less of an issue now and will be much less of an issue going forwards than it was, say, at the back end of last year when we saw front-end gilt asset swap spreads richen significantly. So maybe there's a bit of continued near-term pressure, but I don't think we should be overly concerned about this over the longer term. Okay, that's enough on swap spreads for this pod, I think. So over to Europe then, Giles. It has been the US, I suppose, that's been leading the way in terms of data this week, but we've seen broad-based weakness in fixed income. What's been driving that in Europe, do you think?
Yeah, I mean, it's been a little bit of a puzzle because, and not more of a puzzle necessarily than what's been happening in the UK. And so, there's obviously this global component, but it really, if you just think about what news we've had, just leaving aside for a second the US data, that the labour market data, which I think was clearly on the bearish side for fixed income that Kevin's already been through. Most of the information, it seems to me, this week has been more on the bullish side for fixed income. So it's been more so growth negative. It's been, I'm talking about things like the PMIs, where we had some final PMIs that were revised down quite a bit, and that's pretty unusual. I usually tend to ignore the final PMIs because they just come in line with the flash estimates that we've already had. And the story there is that the service sector definitely seems to have been slowing quite a bit, and that adds to the weakness in the manufacturing that we already know about, of course. And then just a few other things. I mean, it's been, for example, today, just as we speak, it's a real risk-off day. I mean, this is, people try to blame things like the FOMC being hawkish. Well, I mean, you just heard what Kevin thinks about that. I mean, I don't think you would really expect what the FOMC minutes said, which wasn't a lot to necessarily be behind a 2% drop in stocks. But if you get that, you would normally expect that to be a sort of risk-off sort of move that might be more supportive for bonds. Whereas actually, what we've got is a 10 to 15 basis point sell-off today, and that's on the back of quite a decent round of weakness and bearish steepening across the curve in Europe. And so I think there was supply that was quite heavy, particularly today, and so that could have been a component. I don't think that it necessarily explains the UK move to the same extent, but of course we have had a return of supply in the UK as well, and that is continuing over the next couple of weeks as well. So it could be that, but you wouldn't normally expect routine supply like that to really be driving this level of weakness either. And so I think that maybe it's summer markets and summer liquidity together with that supply. I think one thing that I've been talking about a lot, and it's hard to tell how successful it's really been as a theme, to be honest with you, but that's something that I still believe in, and that's this idea that fixed income just really isn't a great counter-cyclical hedge. It doesn't diversify your portfolio that well in this sort of high inflation environment. So that perhaps is something which is just worth considering on days like today, where we have everything going down. Now, then I guess potentially people are starting to think about the way that their portfolios carry going into the summer. So unless you think that you're likely to get the hoped for central bank pivot over the summer, I don't think many people do, particularly this week. Maybe those long duration positions that were supposed to make you rich when that pivot came, maybe you take those off because they're carrying negatively, for example. So I think we're in the realm of sort of ex post rationalization here rather than anything else. But I think you can link this back to theories and themes that we've been discussing on this podcast in recent weeks and months.
I'll allow that. So what about the shape of the curve then? Because we've seen quite a disinversion, i.e. steepening, at the very front end. We've got 2-year rates back to where they were kind of pre-US banking stress, and that would have been what, 2 or 3 months ago now, I suppose.
Early March.
Yeah. So how does that fit with how you see the risks for the ECB going forwards, I suppose, particularly after what you've just said with regard to markets moving in the opposite direction to how you would expect given the growth data, etc.?
Yeah, I mean, I think it's similar to what you were talking about in the UK, where we've got all this demand for front end UK, and I mean, I think it's a bit of a global thing, right? I mean, your safe asset really is cash, and so that's why we are seeing less, I would say, of a bearish flattening than you might otherwise have expected. For the front end, I think that there's maybe a Bondcast special that we should do, where we can really get wonkish about the way we talk about inflation, because there are a lot of new and interesting sort of theories in the academic world kind of swirling about as well, thinking in particular about some of the micro foundations, for example, for inflation. But basically the bottom line is there's still quite a lot of inflation about, and I think the markets are reluctant, perhaps, probably reasonably, to go all in. And I mean, we've seen this in the UK, right? I mean, we've had a repricing of the Bank of England peak rate, 100 plus basis points compared to where we were sort of 4, 5, 6 weeks ago. I think it's much harder to see the ECB, or for that matter, the Fed, really going very much further than what's already priced in. 4% really does feel like a bit of a line in the sand, and I'm not going to put my hand in the fire and say that there's absolutely no chance that the ECB will raise rates to 4.25%, for example. But 4% is a significant level, and so I think it's normal and natural that the markets, as they feel more nervous about inflation and just less optimistic that the turn is going to be soon and it's going to be swift, tend to disinvert the curve rather than looking for a higher interest rate peak and a sharper curve inversion. And so I think that is what that's the reason. It's something that I've been talking about and looking for a couple of months by now, and it's nice to see it happening. But I think that the consequences are that this propagates along the curve now, and that is something that we do seem to be seeing this week.
What about, how are you thinking about summer risks then? We always seem to oscillate between this view heading into the summer that either it's going to be so quiet because it's the summer, or it's going to be so volatile because everyone's expecting it to be so quiet and liquidity is so poor that like markets just whip around. I mean, we're already in a relatively, I would call it, volatile environment. So how are you thinking about the risks through the summer, I guess, for Europe specifically? What will you be watching, or what could be a trigger for kind of summer volatility or liquidity risk?
Well, I think a few things. On the data side, obviously, there's the big question about how strong demand and services demand and things related to holidays and tourism and so on, how well that looks like it's coming in. And so you'll see, well, I guess we'll see that through things like PMIs, but maybe we should be dusting off our pandemic era things like hotel reservation rates and things like that as well. So that's one. And I guess that if that's not tracking reasonably strongly, then that could turn things around. So that's one thing I will certainly be watching. The other thought is obviously supply. In fact, we just pulled the numbers. Over the last 3 years, we have had an August in 2020 where there was enormous quantitative easing, but there was also enormous bond supply in dealing with the pandemic, and so it actually sort of netted out. There was roughly sort of flat bond supply over that period. Then in 2021, it was slightly negative, and then picked up to last year to about sort of positive 40 billion or something. I'm just talking about EGBs here. What I'm thinking about is bond supply subtract with ECB gross purchases subtracted from that. So it stepped up to about 40 billion last year. But last summer was a little bit strange as well, because we had the whole energy crisis, and that was really sort of making people feel nervous about the growth outlook. This summer, we're going to have 50 to 60 billion net bond supply in August. Probably a lot of people away, and maybe we don't have that counterbalancing sort of growth concern. So I do think that could be a bit of a bearish risk. Beyond that, I don't really have any particularly exciting thoughts. I did look through to see what the seasonal models tell us about various things, and June, July, they tend to be quite good news for BTP spreads. I guess we're seeing that more or less. More sort of equivocal for things like Spanish spreads, for example. Might interest you that I think that I identified a bit of a weak tendency for the UK curve to steepen. It is. So in line with the view, let's see if it can happen. but not really in Europe. And I think that might actually surprise a few people, but, because I think people remember 2014, 2019, again last year, when there was a lot of movement. But actually, you look at the sort of broader sweep, and there's no real trend over the summer in anything like curves. So I'm not particularly concerned about that.
Okay. I was hoping for a quiet summer then. Maybe that's famous.
Wouldn't that be nice?
Wouldn't it just? All right. Thank you both for joining me. And thank you to our listeners for listening in. Just a reminder that if you like today's episode, please don't forget to click the like button and hit subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.